It is January 2026. If you walk through the streets of any major financial capital today, New York, London, Tokyo, everything looks the same on the surface. But look closer at the headlines flickering on the digital billboards. They speak of the AI renaissance, of self-sustaining colonies on the lunar surface, and of a world becoming increasingly virtual. But while the masses are distracted by the digital mirrors of the metaverse, a brutal physical reality is tearing through the foundation of the global economy. This isn't just a market trend. This isn't a correction. We are witnessing a tectonic rupture. On January 14th, gold didn't just rise, it shattered the $4,642 per ounce mark. Since the start of 2025, we've seen a 60% appreciation, the strongest performance in nearly half a century. But do not be fooled by the price tag. This isn't about gold becoming more expensive. It's about the fiat currency system losing its pulse. And then there's silver, the devil's metal. It has done the unthinkable, a vertical, violent leap to $90 per ounce. In the blink of an eye, a new class of metal millionaires has been minted, the patient few who held their ground through a decade of ridicule and stagnation. Today, we are going behind the curtain. We are moving past the official narrative to explore the hidden mechanisms that brought us to this cliff. We will answer the questions the mainstream media is too afraid to ask. Why have Western exchanges lost their grip on price discovery? How is a silver deficit threatening to bankrupt the world's leading AI firms? And most importantly, why is a 1 kilogram bar in your hands now worth more than $1 million in a digital bank account? By the start of 2026, the global balance of power has shifted. The BRICS Unified Payment Unit, the R5 currency, named after the riel, ruble, rupee, renminbi, and rand, has moved from a diplomatic dream to a hard financial reality. With India's aggressive chairmanship of the bloc pushing for total de-dollarization, the global south has made its choice. The world has split into two distinct financial hemispheres. In the West, we still trade in promises, in debt, in credit, and in digital entries. But in the East, they have returned to wait. Central banks across the Eastern Hemisphere have stopped hoarding U.S. treasuries. Throughout 2025, a domino effect occurred. China, India, and the Gulf nations began demanding payment for their oil, gas, and semiconductors in either physical gold or R5 units backed by the metal. This created what we call the Great Liquidity Drain. Gold is being vacuumed out of the LBMA and Comex vaults at a rate of 150 tons per month. It's flowing to the Shanghai Gold Exchange, SGE. Today, Shanghai is the world's real price setter. While the screen in New York shows a price based on paper contracts, the physical metal in Shanghai trades at a Shanghai premium of 5% to 7%. Why does this matter to you? Because it proves that paper gold is a ghost. The era where Western bullion banks could suppress prices by selling naked shorts, selling gold they didn't actually have, is over. The physical metal has moved to the strong hands of the East, leaving Western private investors with nothing but digital IOUs. If gold is the king of the 2026 reset, silver is the wild, uncontrollable beast. We have now entered our 5th consecutive year of a massive structural deficit. In 2025 alone, the shortfall hit a staggering 300 million ounces. But here is the silver paradox that caught the world off guard. You cannot simply mine more silver because the price is high. Think about the chemistry of the earth. Over 70% of the world's silver is a byproduct. It is a secondary metal found while mining for copper, zinc, and lead. To increase silver production by 10%, you would have to increase the global production of copper by 10%. In a world of tightening environmental ESG regulations and a 15-year wait time for new mining permits, that is geologically and politically impossible. By mid-January 2026, the industrial panic hit a boiling point. Tech giants Tesla, BYD, Samsung, and Apple realized that without silver, their factories would stop. Silver is the most conductive element on the periodic table. There is no substitute. These giants have stopped buying on the open market. They are now signing direct off-take agreements with the mines. They are essentially buying the silver before it even leaves the ground, bypassing the Comex entirely. And then, the Black Swan event of January 1st. Beijing imposed strict quotas on physical silver exports. They realized that silver is the new oil for the fourth industrial revolution. By hoarding silver, they control the global supply of solar panels and EV components. The West has been left on a starvation diet, and that is what pushed the price to $90. As the shorts on the Comex realize they can't deliver physical metal, we are expecting a vertical melt-up to $120 before the quarter ends. In 2026, we've finally hit the wall of the virtual illusion. We've spent years talking about AI as if it were a spirit in the cloud. But AI is not a spirit. It is a physical entity made of metal and powered by electricity. Every new AI data center built this year requires thousands of miles of silver-coated cabling and millions of microscopic connections where conductivity is non-negotiable. But there is a deeper layer, the energy trap. To power the 2026 AI grid, the world has pivoted to massive solar farms. The newest generation of solar technology, TOPCon cells, requires 50% more silver paste than the panels of 2023. In 2025, the solar industry swallowed nearly 22% of all global silver production. This year, that figure is projected to hit 28%. The industry is literally cannibalizing the investment sector. Every ounce of silver used in a solar panel is effectively lost to the market for 20 years. This isn't a buy and sell market anymore. It's a consume and disappear market. For the private investor, this means that silver coins and bars are becoming extinction assets, items that simply won't be available at any price in a few years. A common question we hear is, if gold is at $4,600, why don't the miners just flood the market and crash the price? The answer is found in the dirt. First, let's look at ore grades. 20 years ago, a good gold mine yielded 5 grams of gold for every ton of earth moved. Today, the global average has collapsed to less than 1.1 grams. To get the same ounce of gold today, we have to move 5 times more rock, burn 5 times more diesel, and use 5 times more water. The all-in sustaining cost, AISC, for miners has skyrocketed. Even at $4,600, many mines are barely profitable because the cost of the energy required to mine has also spiked. Second, we are facing the underinvestment harvest. Between 2012 and 2022, the world didn't look for new mines. We were obsessed with tech stocks. Now, we are paying the price. You cannot build a mine in a day. It takes 10 to 15 years from discovery to the first pour of metal. This creates what economists call inelastic supply. The price could go to $10,000, and we still couldn't produce more gold tomorrow. This is the ultimate bullish reality. The supply is fixed by geology and time, while the demand is being driven by the collapse of the global currency system. We are now approaching the most dangerous moment of the 2026 financial reset. For over 40 years, the London and New York exchanges have traded paper gold. For every 1 physical ounce of gold in their vaults, there were up to 300 paper contracts, each one promising the owner they owned gold. It was the ultimate game of musical chairs. It worked as long as the music played. But in January 2026, the music stopped. A process known in the high-stakes trading pits as deliver or die has begun. Sovereign wealth funds from Asia and South America have stopped rolling over their contracts. They are demanding physical delivery. They want the metal on a boat, headed to their vaults. The vaults at the Comex are emptying at light speed. We are reaching the point of force majeure. This is a legal term where the exchange says, "We know we promised you gold, but we don't have it. Here is a check in paper dollars instead." But here is the catch. When that happens, the price of physical gold will instantly decouple from the paper price. Those who held gold in a bank account will get paper dollars that are losing value by the hour. Those who held the physical metal will be the only ones left standing. This is the moment of truth. Let's bring this 2026 update to a close. Gold at $4,600 and silver at $90 are not accidents. They are the result of a global awakening. We have realized that in a world of infinite digital printing, the only things that truly hold value are the things that are finite, difficult to produce, and impossible to fake. As we move deeper into 2026, our targets remain firm. Gold. We expect a psychological test of the $5,200 level as the BRICS currency is fully integrated into the global trade system. Silver. We are looking for a short squeeze toward $120. Every time the price dips below $80, consider it a gift from a dying system. Remember, in 2026, the line between investing and saving your life's work has vanished. Real assets are no longer a luxury for the wealthy. They are the only life raft for the middle class. I want to hear from you. In this vertical melt-up, do you believe silver will cross $100 before the month is over? And tell me, when the system offered you a choice, what did you choose? Digital promises or physical weight? If this deep dive helped you see the big picture, hit the like button. Subscribe to the channel. Here, we tell the truths that the official reports are too terrified to print. Stay bold, stay vigilant, and most importantly, stay invested in the real world. I'll see you in the next video.